Good afternoon, everybody. I'd like to welcome you all to the halftime talk feature interview series, which is our midweek analysis on international energy markets. And this week, I'm delighted to be joined by Mr. Ehsan Khoman, who is the Director and Head of Emerging Markets Research for EMEA at Mitsubishi UFG Bank Limited and based here in Dubai. Thank you, Ehsan, for joining us today.
Thanks for having me on.
Well, Ehsan, I suppose it's been quite a few weeks since the start of the year in the oil markets. We're going to focus our chat today on oil and oil revenue for the GCC, and of course we have in the last week or two this escalation of the Russian-Ukraine crisis and how that might be also impacting oil prices, and we'll have a bit of a chat about that later. But just to start with a general sort of question for you as a bank. In terms of your forecast for oil prices for the year ahead, we've seen them creep up towards $100 very confidently in the last few days. Where are your forecasts and why?
Sure. Well, let me just phrase this bird's eye view. We're extremely bullish. To give the numbers up front, we have $96 average for Brent this year and $112 for Brent in 2023. So just taking a step back, I guess throughout the pandemic, the market's focus has been broadly squarely on the demand side of the oil equation and the vaccine-led recovery. I think fast forward to now, it is increasingly clear that the supply side is, of course, now top of mind. Now, if we trace back since the onset of the pandemic in March, April 2020, during the height of the initial draconian lockdowns, oil demand collapsed, of course, and the global market was awash with ample supply. And the concern at the time, I guess, was about tank tops, with the supply glut being so excessive that the storage capacity was reaching the top of storage tanks, causing, if we recall back on the 20th of April 2020, WTI to hit negative for the first time ever. Now, fast forward to now, I think we're in almost a reciprocal market. That is, the concern now is tank bottoms, and the scarcity of supply is broadly our overall thesis for this year. So just to dig a little bit deeper, so our analysis of the oil price is kind of broadly premised on two things. One, on if it's a demand constrained model or if it's a supply constrained sort of situation. And I guess the market equilibrium is kind of found in between the intersection of these 2 points. I think from a demand constraint perspective, effectively we're stating that the back end of the forward curve tends to be anchored on the marginal cost of supply. I think a very good case of point is, of course, the shale revolution. Ever since that has happened, oil reserves have been abundant and any increase in demand was met by US shale, even when OPEC was cutting production. I think second, and alternatively, and this is where I think where the markets are at the moment, is a supply constraint model where spot prices are effectively needing to rise for the level of demand destruction to kick in. And for us, this is broadly in between $100 to $115 per barrel. I think, the best example in the past of this sort of situation would be the 2003 to 2014 era when China's oil demand accelerated and supply basically struggled to keep up. And of course, that was referred to as the era of the super cycle in oil.
Well, thanks, Ehsan. Thanks for that great intro, sort of your viewpoint. And let's just talk a bit about a few of the things you just mentioned. Let's talk about supply before we switch to demand. As you said and rightly pointed out, the market is in a very tight supply scenario today, and the backwardation that you mentioned also in the oil price, etc. That we're seeing, and that's due to a combination of factors. OPEC's production is under question. Obviously, it has its output deal at the moment, and it's rolling that over every month. But there have been calls, as you would know, for OPEC to put more barrels into the market, and there's also question marks over whether it even can, and that includes Saudi Arabia. But as we go forward, let's say into the second quarter, and you've just outlined a very bullish price scenario. In Q2, we're expecting more OPEC oil to come on. If not from those countries that are struggling, certainly from Saudi and the UAE as their baselines adjust. Iranian oil, again, we may be closer to that. Shale oil in the US is increasing. So do those factors not sort of temper your bullish outlook?
Sure. I mean, you're absolutely right. Certainly, the expectations of more supply coming online as we move into the sort of the Q2, into the summer months, of course, is there. But I think just taking a step back, the anchoring of why we think we're in a kind of a perfect storm situation is on your point regarding OPEC. I mean, there is an increasing point about, how much can it really bring online? A lot of countries are failing to meet on their monthly production quotas. And of course, the elephant in the room is how much spare capacity does OPEC have? And we think by the summer months, it will hit below 2 million barrels. It's rarely ever hit those sort of levels. I think that's when I think markets will get extremely nervous on the upside. On top of that, of course, deficits in the inventory levels that we're seeing in terms of the OECD numbers and the broader structural underinvestment thesis, which has been going on ever since, I guess, the great financial crisis, which has led to a severe underinvestment in upstream oil and gas capex production. And that's, of course, when you look at it, sort of the futures market, it really is corroborated. I mean, we are in an extreme acute backwardation, signaling severe market tightness. And I think, demand growth, of course, needs to slow down eventually for the physical flow of oil to balance. And hence the reason why we've kind of got such a bullish forecast being around the demand destruction sort of level of around 100 to 115, where we're going to start seeing a slowdown in the global economy that could really lead to prices to correct on the downside.
So you think, what you're saying is you think prices need to get to that level before we see the demand destruction kick in, even for economies like China and India?
Yeah, I think so. I think, we're not at max pain yet. I think maximum pain will come eventually when we start seeing much more higher levels. And I think you'll start seeing that with potentially, industrial output potentially slowing down, maybe showing through in certain high frequency numbers like industrial production, like your PMI numbers. Those, I think, will become increasingly front of mind as we move into the second quarter to see if there is really a slowdown. Because at the moment, we really don't think that maximum pain is at the levels where they are at the moment. We need much higher prices.
Okay, and I mean, you mentioned capex and of course the underinvestment that we've had in oil and gas in general since 2014, 2015 in particular. But of course, we've seen healthier oil prices start to kick in the last year or two. Where do you think that will impact the balance, I suppose, of expenditure that IOCs and NOCs will have towards either the transitionary energy transition type of energy or traditional oil and gas? There's been a lot of calls in the last year as we've seen gas and oil prices spike that this capex really has to kick in again, particularly into gas as a transition fuel, and not ignore that most immediate resource.
That's a great point. And I think it all falls down to how orderly or disorderly do we want the transition. I think, if we do want an orderly path, the sensible approach will be to ensure that we have energy security. And we heard from a lot of energy ministers across the Middle East about safeguarding energy security as the top of mind priority to ensure we have a stable energy market until the engineering challenges around a renewables-led future is solved. Because at the moment, of course, these renewable energies are still not mature enough. They're more costly than your fossil fuel alternatives. So we do need to live in this coordinated state between both a carbon and a non-carbon world until we get to a level where the switching can happen in an orderly fashion. Otherwise, we're going to continue to get, in our view, more higher and significantly more volatile energy prices.
Okay, well, let's talk a little bit about the general sort of macro picture from a monetary policy also point of view. We've obviously got, and of course that all impacts, interest rates, impact oil prices and oil and the oil market. You've got the US Fed obviously, and the European central banks are following suit, usually, if not immediately, then with some delay. But you've got the US Fed reconfirming that has been doing so for many months that it will be increasing rates, albeit not to the extent where we're not going to be able to eliminate inflation. Basically, it's still considered very mild, but nevertheless a measured approach to try and sort of reduce liquidity, the general over liquidity in the market. And I mean, from that point of view, where do commodities and oil stand with the inflation we're seeing at the moment? And do you think that Fed policy will have an impact on tempering that sort of commodities super cycle that we've seen in the last 18 months?
Sure, Diala, that's a great question. I think that's in fact the burning question when we speak with our clients regarding, to what extent does inflationary pressures continue to be matched, of course, with higher monetary policy in developed markets, and where do you want to be invested in such an environment? I think we've done some homework, so let me just spend a bit of time just to go through this. Looking back at each Fed hiking cycle all the way back to the 1970s to see which major asset class actually performs and underperforms. And from our analysis, all the way back to the 1970s, we've had 9 Fed hiking cycles. On average, oil and broader commodities outperform financial assets like your equities, like your bonds, and like your credit instruments. And so just to put this into context, of course, demand is driven by oil is driven by demand levels. Of course, where financial assets, such as your equities, bonds, and your credit, they're driven by growth rates. And so this distinction, I think, matters quite importantly as the Fed hikes, because when the Fed hikes, of course, it impacts growth rates. It doesn't impact your demand levels. And so, of course, unanchored financial assets, they price in forward expectations such as earnings and growth, and of course are a very good hedge against anticipated inflation. But critically, I think once this inflationary expectations become alarming enough to create concerns about rate hikes, which is exactly what's happening right now, I think these financial assets no longer act as a very good inflation hedge. Switching gears, we have oil. It's a spot. It's an anchored, it's a physical asset. It needs to balance every day, and it doesn't depend on the forward growth rates. And so, those are the ones, of course, that are most sensitive to rate hikes. And the level of demand relative to the level of supply today is what's absolutely critical. And given that we're in an environment where aggregate demand continues to exceed aggregate supply, then oil, in our view, continues to remain a very good hedge when you have a hiking environment. And so just as we're seeing it now, I think it's very important, Yala, to differentiate between physical markets and the financial markets in the context of the Fed. And so just to recap, physical markets, of course, are volumetric markets. And to determine if you're bullish or not, you just need to look at demand or supply. And if demand's higher than supply, then naturally you should at least theoretically be bullish. Flip side, you have financial markets. They're driven by dollars, and how much dollars you pump into the financial markets ultimately determines if you're bullish or not. And so I think this distinction is quite critical to note that, when you're in this kind of a late cycle period, as we are now, whenever you do have Fed hikes, normally oil and broader commodities typically outperform. And historically, that has been the case ever since the 1970s.
Okay, and I mean, if obviously we know the GCC economies their currencies are pegged to the dollar at least, and they tend to follow, interest rate hikes in the US more or less in parallel. So we know that's going to happen now in the US, and how is it going to impact the banks here, if you like, and central bank policy here, and can the economies here in the GCC absorb minimal rate hikes, even at that?
Sure, absolutely. You're absolutely right. The GCC, given that the monetary policy is pegged to the US dollar, of course, the exchange rates are pegged to the US dollar. They mimic broadly what the US Federal Reserve does. Our expectations is that they will continue doing so. Of course, if the markets are expecting around 5 to 6 hikes, we think that the GCC central banks will follow suit. I think, with where, of course, the gearing, when you look at the gearings of the banks in the GCC, you have a sort of phenomena where, you're much better buffered if you are a GCC bank relative to an emerging market bank. And we've just done some homework here to see what typically happens in a hiking environment. And normally, because your interest-bearing deposits are quite small, normally in a Fed hiking environment, your net interest margins for GCC banks typically outperform those of other emerging markets. In particular, where Saudi, UAE, and Qatar, those 4 countries, we think they're in a very good position when it comes to the Fed hiking rates. And so normally, those banks in these 3 countries typically do well. And if we are going to expect at least, say, 100 basis points of hikes in 2022, then certainly we think that these banks in these countries will do quite well.
Okay, and I mean, sticking to sort of banking and revenue, but again, going back to oil and oil revenue and prices and you're very bullish for this year and even more so for 2023. And of course, for the GCC economies, that oil revenue is key. And we saw Saudi begin to turn around in its budget in the fourth quarter last year. And with the prices that you're talking about, they're well beyond, at least Saudi and the UAE, well beyond their break even. For budget break even with these oil prices. And so therefore, are you expecting that surplus to come through quickly for GCC budgets in general? And secondly, how do you think that's going to impact their approach to government expenditure?
I think what's really interesting and quite marked, Niala, this time around, particularly when you look at countries like Saudi Arabia and Oman, is that they are treating the cyclical higher oil prices independent from a prudent, a conservative, a consolidated approach when it comes to the expenditure side of the fiscal equation. And you can see that through the budgets. I mean, when you look at, for example, the Saudi budget, their expenditure profile is actually for less spending relative to last year. And I guess it's a testament that they are taking it independently from whatever happens in the oil market. Of course, that's a very positive. I think credit rating agencies see that as a positive, which will certainly be something, particularly for Oman, with some credit rating agencies on a positive outlook for them to potentially be upgraded this year if they were to continue to show not just, of course, higher revenues and a more narrow deficit, but certainly I think from a spending side, if they were to continue showing that on the monthly figures that they are belt tightening, will be very good for the credit rating agencies. I think one item to note would be off budget expenditure, and so of course the sovereign wealth funds in our region are becoming more and more increasingly a central part of the diversification program. And so of course, if they were to start growing those funds from an issuance perspective, then certainly I think that would be needed to take into consideration about how much of that budget will be factored into the sovereign wealth funds relative to the ministries of finance. But at the moment, credit rating agencies certainly I think have seem to be in a very comfortable position about the outlook for this year.
Yeah, and I mean, we had, of course, Saudi Sovereign Wealth Fund, the PIF, asking for a rating very recently. So clearly moved there to want to be more transparent, to open up their book, and obviously with a view to raising finance and getting rated higher as a result and securely. What would you say your headline sort of real GDP growth figures are for 2022 for the Gulf, or for various countries in the Gulf, for Saudi, for the UAE, for Oman?
So again, we're extremely bullish. We're just generally bullish this year throughout. For the GCC as a whole, we have a 6.1% overall aggregate number. So that would be the highest real GDP level since 2011, really. And I think that's, again, both not just on higher oil production through the volumetric levels of oil GDP, but of course, in terms of non-oil GDP, and I think we're going to continue seeing more of that coming through. For Saudi Arabia, we're probably one of the most bullish on the street. We have a 7.8% forecast for real GDP. Again, both oil and non-oil coming through. I know there's a large gap between what we have and I guess broadly the market has relative to the IMF. But certainly, I think, as time goes by, if we were to see more oil production coming through from the Saudis, then certainly, that would help on the oil GDP front. And I think there is a firm focus on the diversification of, trying to, realize more of the National Vision Program through the non-oil fund. In terms of the UAE, yes, I think we get asked a lot regarding the Expo. I think Expo is only one part of the broader story. I think as we're kind of moving away from a pandemic status more towards an endemic status, I guess quite soon from a COVID-19 perspective, I think the UAE, given it's the most diversified in our region, is the most best placed to really, accelerate from a global recovery perspective. And we call it the 3T models: the trade, transport, and tourism model. And I think those 3 Ts in the UAE will certainly have recovery coming through. In terms of Qatar, Kuwait, and the other 2 smaller GCC countries of Oman and Bahrain, again, very strong numbers we have for this year, much larger than last year. And again, it's just, I think what's different this time around is not just being reliant on one sector. We are seeing a continuous drive of realizing that this time is different, and we are trying to get more of the diversification coming through and realize more of the national vision programs.
Yeah, and of course, part of that diversification is obviously the money is needed to do that, and one revenue source is oil. And what would you say would be your sort of forecast for the year ahead? This continuous sort of enthusiasm towards IPOs for the region and for some of the national sort of segments of the economy here, albeit small tranches. We saw Aramco doing something last year in ADNOC, but do you with a higher oil price forecast for the next year or two, do they now feel a bit more secure and there's no need to go out there and raise that kind of cash?
That's a great question. I think, I guess it's a case by case. I wouldn't generalize it. I think every, counterparty does it differently. We'll have a look at, what would make sense for their business model longer term. Broadly speaking, though, certainly I think there is a drive to deepen the breadth and depth of the financial markets in our region. And I think as time goes by, that will inevitably be, continually grown. And I think, of course, we've seen that particularly in the UAE, in Saudi Arabia. And so I wouldn't be surprised if there were to be more announcements as time goes by. And I think that kind of speaks to the volume that, if you want to grow and deepen your emerging markets and eventually sort of, be able to compete with the more, I guess, established, more mature developed markets in, say, places like emerging market Asia, in places like Singapore, in places like South Korea, then certainly I think the financial markets is a key lever of that. So if we were to see more coming through, then certainly I think that would speak, at length at that aim.
Okay, Ehsan, and I suppose I've got one more question for you, and we've been very positive so far, so it all looks very rosy. So just one general question, and let's talk a little, let's maybe work into that, what we're seeing now on the Russia-Ukraine side, just in terms of the impact there on sort of, global instability, the fear of what may or may not happen as a result, to Europe and America's involvement, etc. Is that casting any nervousness to sort of predictions for economies, whether in Europe or the GCC? And what risk does it carry, let's say, for the oil price and for the volatility, perhaps, that might be?
Sure, you're absolutely right. I mean, the way we've been mapping it out is extremely bullish, but of course, we do acknowledge that, there will be probably bumps and bruises on the way. I think maybe just trying to bring it all together from an energy market perspective, as well as just a broader global macro and regional perspective. I think the biggest thing, I guess, that keeps me up at night, and the biggest thing I worry about when it comes to the energy market is if we are underestimated or misreading the spare capacity of OPEC. And I think that is extremely, extremely important. And I think as the monthly sort of, OPEC meetings happen, this is not a very clear number. Of course, there is a lot of estimates out there. I think that's an untested number. If we were to get to the levels of 2 million barrels per day by the summer that we think, then certainly that will very, very much nerve the markets. But indeed, we acknowledge we may be misreading that number, and it could be much higher. And I think as the weeks and months go on, hopefully there will be more communication about how much real spare capacity, particularly in Saudi Arabia, UAE, Iraq, and Kuwait, those 4 countries have, that can really help try to minimize the sort of the deficits that we have in the market. I think broadly speaking, beyond that, of course, there are a number of things that sort of, we have in our radar that I would like to sort of flag. First and foremost, COVID, we mentioned that we're thinking that it's going to come from a pandemic to an endemic stage. I think one of the biggest things for COVID would be China and the zero COVID strategy. I mean, that is still in place. If we were to see another iterative variant, that could potentially cause some sort of, unforeseen spike that could lead to a sharp slowdown in Chinese growth. And I think certainly that could dent the demand side of the recovery. Of course, Iran, you mentioned it earlier, it's a major swing barrel. We know that. I think, we've had 8 rounds of iterative negotiations. Are we going to get a revival of the JCPOA? Is it going to be a JCPOA 2.0? I think it's all up in the air. Certainly, I think that the need to accelerate more barrels onto the market, particularly from the US side, is clear. So there seems to be some acceleration. But I think our base case is that we think there's going to be an interim deal by the summer, but a real clean, full return of Iran back onto global oil markets from a crude perspective would probably be a 2023 story. So we're a little bit bearish about Iran.
And just on the Iran fact, there have been people who say, well, yes, whether we reach a deal or not now in the summer, by the end of the year, we're already seeing Iranian oil on the water, and we're likely to see more and more of it the longer the sort of deal stretches out to be reached. So some people are questioning, does it make any difference anyway? Because Iranian oil is getting into the market, it's getting leaked there. You mentioned China, which we didn't really touch on in terms of the demand picture from a COVID point of view, but just to quickly mention that and ask you about that. The demand picture from China, putting COVID aside, I think really more because of their economic policies of the last few months in terms of have they come down on certain sectors in their economy and trying to sort of tidy things up, clean things up, supposedly. That has had an impact on their growth last year, as well as COVID. Is there a sense that the year ahead, from a demand point of view from China, is this a new normal to see the GDP growth that we saw last year, or are we going to see the GDP of old come back?
Sure. Speaking with our China analyst who sits in Hong Kong, speaking to her regularly, she's of the view, and I think this is sort of the house MUFG view, that we are going to sort of see a continued pivot away from, of course, manufacturing towards services, which will mean, of course, more mature growth levels, i.e., much less levels. But how that will impact, of course, in terms of the broader global GDP levels, yes, that could potentially mean less levels, but the value and the quality of that GDP growth will start coming through, because, of course, the economy has, from a composition perspective, has adjusted. But if we were to see any slowdown, and again, I go back to COVID, it is a huge risk. The authorities have been resolute about how they want to go about tackling it, and to some, of course, is extremely successful given their very small small levels of fatalities. But if we were to see any, and that is a real big risk, that if we were to see any serious slowdown in China, then the ramifications that could have, both, I guess, from an energy market perspective, but just a global growth perspective, could be something that it is a major risk. Absolutely,
particularly as one of the main consumers of the markets of the oil that's coming out of this region. So the GCC countries will be hoping that growth will continue. Ehsan Khoman, head of emerging markets for EMEA at MUFG. Thank you so much for joining us today for Halftime Talk. I'm afraid we've run out of time, but thank you for your insight, and we'll see you soon. All the best.
Thank you for having me.